Part B of the required says calculate John Ringman's normal tax. So normal tax, guys, not just taxable income, for his 2019 year of assessment. Provide calculations and brief explanations where necessary. Okay, so what I would recommend you to do if you have a script 2 pages like that is I would recommend that you do lump sums on the first page and then the other normal tax on the second page onwards, because lump sums are usually a little bit shorter. That's the one recommendation. The other recommendation which I can have is that you have a column for lump sums, CGT and rands, and then you do the lump sums in the correct column. Okay, this is often shown like this in textbooks. Personally for me, I struggle a little bit to always fit my answer in not neatly enough, so this is something for you to be aware of. Okay, so normal tax, description, calculation, explanation, CGT and rands, and then the same headings excluding CGT for lump sums. Okay, I'm just going to make a rands column. Okay. Now again, this person's tax year runs from the 1st of March 2018 to 28 Feb 2019. Now let's start off with the first time we encountered John Ringman, which is the when we look at Cassie tapes. Okay, Cassie tapes, they give him a dividend in specie on the 15th of April 2019, and then when the company is liquidated, he gets that dividend. That is what we calculated in the first part of the calculation or of the question in part A. Now, both of those amounts I want you to see, 31 October 2019 as well as 15 April 2019, are all after the end of his tax year. So it's not in this tax year. So I'm going to just start by addressing it. Dividends from Cassie tapes. Okay, so that's not sneaky, but it's something to just be aware of. It's because the Cassie tapes tax year runs from the 1st of January 2019 to 31 December 2019, and John's runs from the 1st of March 2018 to 28 February 2019. So there's some overlap, but a lot that is not. Okay. So just as a quick reminder, John worked for 8 months, then he retired, and for 4 months he was retired. Okay, so let's start at the top. Now, when we do section 11F, the Provident Fund deduction, remember that is limited to the lower of 350,000 or the greater of 27.5% of either the taxable income including CGT or remuneration. So we have to be able to work out remuneration. Now, you can do it however you want. What I would just recommend you do is when you're doing his normal tax calculation, is try and keep all the remuneration items together. So those are the items he receives from Cassie Tapes, or not from Cassie Tapes, from Salbert Limited, his employer, as well as things like annuities, because remember annuities are classified as remuneration. keep them together so that you have to do less work. So I'm going to do the same here, and your solution will also show the same. Okay, so the salary is remuneration, the leave pay is remuneration. Let's do those two first. So salary, 75,000 times 8. The leave pay. Then the golden handshake. The golden handshake is not, or is a severance benefit rather. So it does not go in your normal tax. If you had now lump sums here, you would put it in your lump sums. I'm just going to put it under my lump sum heading. Again, if I'm not saying severance benefit, and even after my discussing earlier in the reading time, if you don't know what a severance benefit is, please make sure that you go and revise this. 75,000, he gets 120% of the amount of his final payslip. So it's treated as a retirement lump sum. So salary, leave pay, golden handshake. All of those amounts, done. Then we have the Salbert Limited shares. Now remember with the Salbert Limited shares, this is section 8C. They tell you that it will vest on the final day of his employment. So we have to include it when it vests. So shares, section 8C, they tell you it is 5,000 shares, he paid £8.50 a share, and you have to compare it to the market value on that day. Remember, this could also be a loss if the value of the shares had decreased. So 5,000 times £10.50 the market value minus £8.50, 10,000 rands. This is also remuneration. If you go and look at the fourth schedule, the definition of remuneration, it includes section 8C. Okay, then I tell you he has to sell it now at 115% of the market value. So, sale of shares, this will be capital in nature, he's not a share dealer. Proceeds is 5,000 times £10.50 times 115%. So that's 60,375. The base cost of the shares is the market value on the date that it vests. So 5,000 times £10.50. So it gives us a capital gain. 7875 goes into my rands column. Done. Okay, then we have the medical aid, travel allowance, and the provident fund. So again, just a reminder, I'm going to do the allowances for the travel allowance right at the end when I do CGT, right before CGT. So I'm not going to do it now. Medical aid and provident fund both had a fringe benefit component in it. So that's what we'll do now. So fringe benefits. Okay, so the fringe benefit, 6,000 rands per month while he works. And the provident fund is his salary, 600,000. times 7.5%. Okay. Then we have the share portfolio. You received this dividend of 65,000. Now I'm not going to include it right now because it's not remuneration. Actually, sorry, what am I missing here? The Provident Fund, sorry. The Provident Fund. He receives a lump sum of 1.5 million rands and 85,000 of his contributions have been disallowed. Now remember, when we're looking at past contributions, you apply it in the following order. First against the lump sum, then against any annuities if there's anything left, and then in terms of section 11F. So, lump sum, he receives 1.5 million rands. So this is the Provident Fund. So under lump sums, guys, make sure you see 1.5 million. And this is our past contributions disallowed. Gets a deduction over here. He then receives an annuity of 72,000 rands for 4 months. Annuities are remuneration. Now I know you might say, but he's not getting it from his employer. Doesn't matter. That's not what remuneration says. Annuities are included. Make sure that you see that. 72,000 times 4 gives us 288,000. Okay, so if we add all of that up, we call this is 1,019,000, and we'll call this, I'm going to call this subtotal A. Okay, let's give it a nice label, so because if you give it a label like that, then you can refer to it. Okay, so let's go on. Let's go to the share portfolio. Okay, so let's look at the share portfolio over here. So the share portfolio, he received a gross dividend of 65,000 on the 15th of July. That's in this tax year. And let's do it. So we're now just going to continue after our subtotal we calculated. Okay, so what was this date? Dividend, 15 July. $65,000, and remember all your dividends are exempt. Now I know there's a variety of dividends in this question, and you can add all of them up, claim just one exemption there. I'm just doing it for now as I'm going. Okay, he then sold it on an interest-free loan. Right, so this is the disposal of his shares. He sold it for 340,000. Let's do that. Proceeds 340,000. Then the base cost. What is the base cost? So that is the little trick there. The base cost is you have to use the base cost for your spouse because of section 9 HB. Remember again, if you receive something from your spouse, you take over the information. Okay, and that goes into my CGT column. Alright, and then it now jumps into Hercules Limited. As you can see, it goes on from there. Now, you need to remember to just consider if anything else is applicable. And if you remember the trust, he now sells it to the trust. Right? So this dividend income here, the net amount received, is from John Ringman. So we need to decide, should he get taxed on any of those amounts? So we look at these amounts over here. Remember, this is also the net amount. Okay, so the amount to Alex. Alex is a non-resident. So, was there donation and is the donor alive? Remember this question we asked. Was there donation? Is the donor alive? Yes. Does Section 7 apply? Yes. Alex is a non-resident. So, who should be taxed on it? The donor. Section 7(8). Savannah, she's the minor child. So, Section 7(3) will apply. And then the question also told you that no one has a vested right to the income retained in the trust. So, Section 7(5) applies to that. John should be taxed on that. Okay, but now, before we continue, what is important also for us to know? The total, so you can, this total amount over here, the 16,000, is basically those amounts broken down. If I say 16,000 times 100 over 80, I get 20,000 rands. Now, I'm just going to do this in my proper calculation. So let's call this dividends from the trust. So volage limit. And we do the volage limits because he sold shares on interest-free loan. So the volage limit will be the amount that he sold it for times the interest he charged minus the interest he should have charged. Well, so rather, let me say it the other way around. The interest he should have charged market value minus the interest he did charge times the period of time. Now, he sold this to the trust on what date? 1 August. Okay, so this is 1 August 2018 to 28 Feb 2019. So August, September, October, November, December, January, February. 212 days. So 212 over 365. So what we're calculating here with the volage limit is the maximum amount that he can be taxed on under Section 7, and that is 21,723. So he can't be taxed on more than that under Section 7 for this specific transaction. But like we just saw, if we go back to the question, it's 20,000 in total what the trust received. So it's less than that. So as the amount, well, let me say it like this, as amounts subject to Section 7 does not exceed the volage limit, there is no limit. Okay, so let's go. So now we have dividends to Alex, Savannah, and the dividends to, I'm saying there, well, let's just say retained in trust. So Section 7(8) applies to Alex. You only have to write that, but I'll just say non-resident. It's a donation to a non-resident. You can either write donation to non-resident or Section 7(8). Savannah, Section 7(3). Again, that's fine to just write that. So if you know the section number, you save time. But this is donation to minor child by a spouse. And Section 7(5). This is no person with a no retained income. No one with a vested right. Remember, guys, Section 7(5) only applies to the income retained in the trust. And the only how it works is you ask yourself first, does someone have a vested right? Then they should be taxed, unless Section 7 overrides it. If no one has a vested right, like in this case, then the donor should be taxed. And if there is no donor, then the trust should be taxed. Okay, so for these amounts, 6,400 and 3,200. it's basically 6,400 times 100 over 80, 6,400 times 100 over 80, and 3,200 times 100 over 80. Okay, because remember, dividends tax of 20% has been withheld. So guys, also remember, none of you guys are stupid. So you won't say 6,400 plus 20% or something like that. That obviously doesn't make sense. Remember what happens here is you had 8,000, that's 100%. You deduct 20%, so that you're left with 80%. That 80% that you're left with is 6,400. So how much was the 20%? You basically have to add it back. So if I say 8,000 times 20% gives me 1,600. Can you see? So that's how it works out. So you have to work it back. Remember, multiply by what you want over what you've got. Just pointing it out. Sometimes students do stupid things there. Don't be one of those. Section 10, 1K is now the 8,000 plus the 8,000 plus the 4,000. And remember that 65,000, we already claimed it there. If you didn't claim it there, you also add that here now. Okay. Nothing else. And now we can add all of this up. And this is all just exempt, so 1019. And we call this subtotal B. Okay, so now we've done gross income, exempt income, and deductions. We're now ready to start moving on to CGT and all of those things. So what we have to do now is this travel allowance before we do anything else. Okay, so let's do the travel allowance. Okay, you have to know what the total kilometers are, and you have to know what the business kilometers are. They give it to us in this question, so you don't have to write it out like I'm doing there. I personally just always like to do it so that I have the information really available. Okay, so now we have to calculate the deemed cost per kilometer. So we get our fixed cost per our travel allowance table. Now please remember guys that this vehicle has a cost of, what is it, 350,000. You have to use the amount including VAT, excluding finance charges. I'm going to go to my own tables that I provided here. You will use the everyone are appropriate and correct in the exam. Okay, so 113,179. And this is, then you have to apportion it for period. So it's 113,179 times. He worked from the 1st of March to the 31st of October. That's 245 days. You have to apportion this per day. If you go and look at the Government Gazette, which is where this was stipulated, you can find it in your regulations section, in your Psycho Student Handbook also. It specifically tells you must apportion it per day. Alright, so that's the fixed cost for the period you used it. Remember guys, that fixed cost there is for the period used. So now we have to calculate the fixed cost per kilometer. So 75969 divided by business or total. Always total guys, remember, always the total, otherwise you're implying that the vehicle only costs you money when you use it for business, which is obviously absurd. 521.7 cents. I rounded down, expressed in cents, I rounded down to 1 decimal. Why do I do that? Because this table is also written in that way. Then we've got our fuel and our maintenance. Fuel per table. Maintenance per table. 127.2 cents, 58.2 cents. We add all of that up. Gives us 707.1 cents. Right, so our taxable travel allowance is the travel allowance received which was 9,500 rands a month for 8 months, 76,000, less our business kilometer or business cost, which is 707.1 cents, times our business kilometers of 10,124. Okay, remember to express it in rands. If you're still saying 707 on your calculator, that's in cents, you have to divide it by 100. Alright, so this gives us an amount of 4413, and that amount goes into my rands column. Now I'm just going to make a comment here also for you. You can do the same in the exam to remind yourself, because you'll use it. The remuneration is 9,500 times 8 times 80%. That is, remember, remuneration is 80% of the travel allowance. Okay, 60,800. Don't include it here or anything here. This is a calculation which you are going to be using shortly. Okay, now the order is important. Okay, let's call this subtotal C here. This is 1023413. First, we have to do our taxable capital gain. Okay, so we go up and we add up everything in our CGT column. The 7875, the 190. Okay, that's it. So we add up everything in our CGT column. Right. This is where my CGT column runs. From that you deduct your annual exclusion, because there's a natural person. This gives us our aggregate capital gain. Remember, the aggregate capital gain is always after the deduction of the annual exclusion. 157,875. I'm just reminding you, in case in the question they tell you what the aggregate capital gain is, because then you need to know they've already taken into account the annual exclusion. Then we have to bring forward any capital loss from the previous year. None in this case. This gives us our net capital loss. Then we have our inclusion rate. 40%. This gives us our taxable capital gain. 63150. Now, exam technique and tip here. If there was any disposal of an asset, you might have calculated that the CGT on that, the capital gain, so it goes into your CGT column here, was null. All I want you to do is, I want you to still write out this. So what I'm trying to say is, let me show you. Let's say you thought it was null. Put down the null there. Write out annual exclusion. Say it's null, null, null. Do the 40%. Say it's null. The reason why I'm saying that is, sometimes what happens is you miscalculate something. Or you miss a CGT. And then in the question, or in the solution, they obviously will do it like what I did here. Then there will still be marks for the 40,000 and marks for the 40%. Which, if you just stopped here because you thought there's no CGT or the amount was null, you miss out on potentially. So, just my little tip there. I recommend you take that into account. Okay, so now We add up everything again. And I'm going to call this subtotal D. So as long as you label it, you'll see you can use it. Okay. In my actual solution, I might have a slightly different subtotal numbering and things, guys. It's not the end of the world. Okay, so just follow whatever I've got there. So section 11F, here we go. So the first thing we do is we start by saying what is the actual contributions. So there was a fringe benefit, and there was by the taxpayer. So how much did the company contribute? The company contributed, if we go back up, Provident Fund contributions, 45,000 rands. The question also told us that it was on a rand for rand basis. So you can recalculate if you want, but if we've done it already correctly, it would mean that both the employer and the taxpayer contributed 45,000. Now you have to write out clearly your limits. You have to state it. Okay, this part of showing that you know the application of the Act. So limited to the lesser of 350,000 or 27.5% times the greater of the taxable income including CGT, which in our case is subtotal D here. Subtotal D is the subtotal right before the section 11F. Okay, that's what I've got here. Remember, yours might be a different reference. The solution will also have a different reference. Doesn't matter as long as you just refer to your own work. Right, whatever you've got. And then remuneration. And I'm going to say a C calculation. Okay, then give yourself a couple of lines of space. Quite a bit, so that you can have enough room at top. And this is our remuneration calculation. So now we have to include everything that's remuneration. Now, when I prepared my solution, you'll remember at the beginning, we did all of the remuneration. Salary, leave pay, golden handshake, shares, the fringe benefits, the annuity. We call this subtotal A. So I've already done most of the work. Subtotal A. So I can put that down. If you didn't do that, you would now have to calculate somewhere and make it clear to the examiner what the amount is. So you might have to list salary, leave pay, and put down all the amounts. But you can see it will take a lot of time. So use subtotals. Really recommend it. What's the remuneration that's not included in that subtotal A that we have there? Okay, if you go down the screen as you go, dividends, no, it's not remuneration. The travel allowance. And you'll remember that 60,800 travel allowance remuneration. That must be included. Okay, so 1079. 800 is our remuneration. Okay, so our remuneration, back to our section 11F limit, 1079, 800. So which is the greater of these? 1079 or 1086? This is the 1086. So DAS, 27.5% times 1086,563. 298,805. Now before I continue, I want you to see here, guys, once you've calculated a subtotal here, any of these places, I recommend that you keep that subtotal in stone. What do I mean? Let's say you now realize there's 1086 over here. Oh no, I forgot to include at the top this annuity. Just go and include the annuity, but don't change the subtotals. Yes, if someone had to add it up, it won't add up, but there's no mark allocated for subtotals, so you won't lose a mark. Why I say you shouldn't change it is, if you change it there, then you have to change it in every single subtotal place. And, more importantly, you have to make sure that you change it there and there. Because if your examiners, where there will be a mark, is they're going to see if this amount that you've got there ties into your subtotal there. So if you've missed one of those changes, you've got a problem. So if you've made a mistake and you've missed something out, keep your subtotals there. Honestly, you could thumbs up your subtotals and you'd still get your marks. Okay, just my little tip. And then our third limit of section 11F, so we say limited to 350, 27.5%, or the taxable income excluding CGT, which in our case was subtotal C. So it's before our CGT. Here's our taxable capital gain, subtotal C, the total right before it. 1023413. 1023413. Okay, so our limit is the lesser of 350, 298, or 1023413. Okay, so what is our lowest amount? Is this 298. So you have to conclude that. So thus, lower is 298805. That's the first conclusion. Your next conclusion that you have to reach is, can you claim how much of this contributions can you claim? 90,000 is what we want. Our max is 298. So we can claim everything. So you'll say then, no limit to contributions. We claim our 90,000. There we go. Okay, now I add up everything again. Okay, just using the mouse from the little solution, but you'd obviously add it up. This gives us our taxable income. Right, we have to calculate tax liabilities. Now we say tax per tables. So guys, you go to your tax tables. And you just use whatever tax table is appropriate. So 996563. Sitting in this bracket over here. So 208,732 plus 41% of the amount which exceeds 17. Okay, 208,732 plus 41% of the amount, 996,563, which exceeds 710. 326,223. Then we deduct our primary rebate, and because this person is 65 or older, we do our secondary rebate. Again, guys, this changes every year. Use the correct amount. In my case, like I said in the beginning of this question, I'm just using this, what I've given you guys here. This is just to make sure. Alright, so, or you just need to use the correct ones in the exam. You obviously won't have this information. So, or my specific figures is what I'm trying to say. Use whatever is appropriate. You have to use the latest figures. So it's in the latest ICA student handbook, and if you don't have it, it will be in the information provided in the exam. Use that, please. Okay, important now. Then you have to add your tax on lump sums. Then you will do section 6A and section 6B, the medical. You have to do the tax on lump sums here. Not at the bottom, not anywhere else. You have to do it here. Otherwise, you'll lose a mark. Okay, so go back to our lump sums. Let's calculate the tax on this. Okay, so we add up everything in our lump sums. 1505. That's taxable income. This person is retiring, so you have to use the correct tables. There's the withdrawal table and the retirement table. Retirement and severance benefits table, so we use that one. We're in this bracket here, so it's 130,500 plus 36% of the amount which exceeds 1,050,000. So tax per retirement table. 130,500 plus 36% of the amount, 1505, which is our taxable there, that exceeds 1,050,000. And that gives us 294,300. This 294,300, we now go and enter into a calculation. Then section 6A. You get section 6A for each month that you belonged to a medical aid. Now, this person belonged to the medical aid the entire year. First, Albert paid, and then he paid, but he belonged to the medical aid. So, 12 months. Now, remember, guys, Section 6A again is a figure changed every year. They give you those amounts in your Psycho Student Handbook. Right? In this case, I've given it to you here. It's 300 rands per person per month for the taxpayer and one dependent. After that, it's 200 rands. Okay, so my figures here. Obviously use the correct one. So 300 rands for him, 300 rands for his wife, times 12. Okay, 7,200. Then Section 6B. This is a person who's 65 or older. So how does Section 6B look for him? We say medical aid contributions. We calculate how much came from a fringe benefit and how much was contributed by the taxpayer. So basically what we're trying to say here, we're trying to figure out how much was the total amount paid to a medical aid. Now the amount paid by the employer was 48,000, you'll remember 6,000 rands a month. And how much was paid by him? Medical aid, he paid 4,500 rands per month himself. So 4,500 rands for 4 months because he was retired for 4 months in this tax year. So 18,000. Added up, 66,000. Because he is 65 or older, we deduct 3 times Section 6A. So whatever your amount is there, times 3, 21,600 in my case, gives us 44,400. That we multiply by 33.3%, so 14785. Okay, I'm not putting it in my rands column yet. Can if you want, but I would just recommend you just do it like that. Then we have our other qualifying medical expenses. So these are amounts paid, but which have not been claimed under the medical aid, which is that 85,000 for the back operation. So 85,000 times again 33.3% gives 28,305. Add that up, gives us 43,090, and that gets deducted against all of his other taxes there. Add all of that up, and that is his tax liability or tax for the year. Again, guys, please remember Section 6B. If he was disabled, or his spouse, or a child, you would have done the same thing. If he was younger than 65 and no one with a disability, then it would not have looked like this. Okay, make sure that you go and revise that. If you're not sure what I'm talking about, please make sure that you revise that. Okay, that's it. So, in our next recording, we will continue.